welcome everyone. My name is Nakul Karg. I'm the co-founder of CrowdInvest. Today we are collaborating with Foundership. It's one of the Web3 incubation program run by Pranav and team who are with us today here. They are based out of Dubai. So what we are doing today is a Web3 crypto investing masterclass on that. Pranav and their team is our expert on that, and we will be giving a brief introduction about Pranav later. So let's move to the next slide. Yeah. So a quick introduction about CrowdInvest. CrowdInvest is headquartered in Mayfair, London. We are a blockchain-powered alternative investment platform connecting global investors with startups across the world. We have a 2,000 plus investor network, including HNIs, family offices, and venture capital firms with successfully closed deals over 100K on an average. So we have Pranav from Foundership. He's the head of capital at Foundership Ventures, and these guys have incubated to 40 plus Web3 startups, and they are headquartered in Dubai. I met Pranav through a mutual connection, and then when I was in Dubai, we had a face-to-face interaction, and then we planned out we'll organize something together, and then here we are today. So yeah, over to you, Pranav. Yeah.
Hi, Nakul. Hi, Tanya. Thanks a lot for having me and basically Foundership along with us to and CrowdInvest to sort of, help a lot of angels realize and understand better how Web3 is different and how Web3 can also be risk managed, but also an excellent opportunity to participate from the angel investing side. So super excited to be here. We have a few slides. Generally, I love to sort of uh, interact with the crowd or the attendees. So at any point of time, feel free to raise your hand if you would like to ask a doubt. Or if you have a question, just throw it in the chat box and we'll take it up at some point in the end. If you think it's not something that's like, super relevant on what's on the slide. But uh, generally, anything you need, just feel free to interrupt and go for it rather than, so that keeps me from looking at a computer and talking to myself. So very quickly about myself, I used to be a coal miner for 15 years, worked in TradFi across India, Indonesia, USA, Africa, and mainly on Wall Street doing M&A. I was the CFO for a large enterprise based out of the US. I currently have Bitcoin miners in the US as well. And at my core, I'm a Bitcoiner. I'm a certified Bitcoin professional. I moved into Web3 full time in 2022 after about 5 years dabbling in it, trading, investing through various sources in my network. Generally, I write about crypto every day, either on social media or otherwise in my Telegram group. We're setting up a $10 million fund to invest in Web3 companies. And I lead the ventures arm at Foundership as my day job. Foundership is a Web3 accelerator and fund. We have 40 plus companies from over 10 countries that have been through our program. The top 12 companies are valued at about $80 million. And we're looking at taking a few of these to the market by tokenizing them and listing their tokens in the next few months. So like I said before this, I worked across multiple geographies. I used to be the CFO for SR's mining business in USA, and I did my MBA from IIM Indore in 2008. The most, I think what's important to understand is what you'll hear me say very often is Web3, words like crypto, Bitcoin, tokens. So it's very important to understand why it's called Web3 and what's different about Web3 and how this nomenclature came about. So what we know from the last 20 odd years that the internet has had public adoption is that it went from Web 1 to Web 3. So in the early 90s, all the way up to 2005, the first version of the internet, as we call Web 1, was basically all of us reading from static sites and consuming what's mentioned on the internet. Most content on the internet was from academic research or businesses that had stuff put out there. 2005 onwards, basically the birth of social media led to what we call today as Web 2. In that, a lot of user generated content was basically was created, and therefore you not only interacted by reading off the internet, you also contributed on the internet. So whether it's things like social media, Wikipedia, blogs, and then the whole social media movement, right from Facebook, now Meta, all the way down to YouTube, Instagram, TikTok, all of that is part of what we call as Web 2. And essentially, the biggest problem that we saw with Web 2 was it led to a collection of often referred to as FANG companies, but sort of platforms got centralized into having one source of control where both value and decision making got centralized. And we saw a lot of content creators. You would have heard of singers on Spotify or YouTube channel creators on YouTube, Instagram, etc., always crying about the share of revenue that they generate coming to them. 2020 onwards, effectively, what we saw is Web3. This is the read, create, and own part of Web3, right? And this is where we're seeing that certain technology and certain technological developments and advancements allowed people to not only create but also own a part of what they're creating, thereby getting a lot more rev share from what they created plus what others around them were creating. So that brings me to what is Web3, and in terms of what are the core tenets of Web3, and also what sort of comprises what makes the foundation of Web3. And even at Foundership, when we look at evaluating a company or a startup that applies to us for a Web3 program, these are the elements we look at. So you have blockchain, which is the fundamental underlying layer. You have smart contracts, and we have digital assets and tokens. So we want every startup that calls itself a Web3 startup to have at least one of these elements. It should either be a blockchain or built on a blockchain. It should either use some form of smart contracts to interact with the blockchain, or it must issue mint slash trade digital assets or tokens, right? So at least one of these three is what we want to see in a startup when we classify it as a Web3 startup. In terms of applications, there's a few mentioned over here: DeFi, gaming, social, art, and media. But today we've seen everything from marketing, brand engagement to everything that goes around us in terms of real world assets, like you're seeing housing, gold, T-bills, all sorts of things come to Web3, come on chain and get tokenized. So the width of Web3 is growing every single day. And the most highest adoption has been seen in gaming, DeFi, social, art, and media. So these are sort of the very basic elements of Web3, but we'll look at it more in detail. And absolutely, if anybody has any questions, please feel free to sort of raise your hand or put them in the chat. But what we're here for is sort of angel investing, right? So I know a lot of us are interested in angel investing. Some of us may also be actively investing in startups as angels. How many here have some form of angel investing experience? Do you mind sort of just saying yes or no in the chat? Would love to hear more if you have any angel investing experience. Cool. So
So
we've
we
got
have
a
some responses. Yes, no, both of them. So maybe we have some, newbie investors as well who are just trying to maybe start with crypto.
Sure, perfect. So, for me, angel investing principles remain the same. It doesn't matter whether you're investing into a traditional business or whether you're investing into a startup business. But what I am focusing on for this purpose of this presentation is mainly tech-enabled businesses, right? So it could be Web 2 or Web 3, but we're looking at tech-enabled businesses because these are businesses that typically what we call in the industry can give us a J curve or a hockey stick growth, right? So just like uh, you have, suppose you have a steel plant, something I've done for a long part of my career. If I build a 1 million ton steel plant, I can't generate 2 million tons from it tomorrow morning, right? I would have to go through a whole capex cycle, build out 2 million, and then be able to serve the 2 million market. Whereas
Pranav, we
when,
have a question when you're ready.
sure, go for it.
So it says, keen to hear how angel investing will be impacted with tokenization.
Super. Yeah, we'll get to that absolutely in the next couple of slides. And when we do tech investing, what we are all investing in is that because they are tech enabled businesses, as they scale and they find what we call as product market fit, the adoption curve goes through a J curve, right? You suddenly see a spike and a boom like a rocket, the adoption curve and the user growth takes place. So, what we're all trying to achieve is the high growth tech businesses that we want to invest in so that the investment goes into multitudes of returns. If you want to do traditional investing, the stock market has been the darling of the investing world for the last 5 decades. And I think for traditional investing, the stock market is the best, right? That's why even if you see uh, the tech startups, the end point for a tech startup is to go to the stock market and list in whatever is the relevant stock market or accessible stock market for them after they hit a plateau, right? So after you typically list, you're not going to go for explosive growth and therefore you're not as attractive to VCs or angels. So my first point, the first step anybody in their angel investing journey should do is choose your area of interest. You should not have more than 3 areas of interest, ideally one or two, because it's impossible to keep track of 10 different industries across the world, see what's happening, create enough deal flow, etc., in multitudes of topics. So, therefore, my suggestion always is to keep a maximum of 3 areas. So Web3 could be one, payments, fintech, agri-tech, health tech, AI. We're seeing so many SaaS, B2B SaaS. We're seeing so many different domains or industries that you would have. And you can also include some amount of geographical preference because you should be able to understand the market that they're operating in. Otherwise, you are not going to be able to evaluate which deals to get into. So, the way to choose your own areas of interest is based on experience and knowledge. So, let's say if I were to use my traditional experience of 15 years, I would say things like commodities, wealth tech, capital market tech, etc. is fintech is sort of where my preference would be. Do I have deal flow, right? So a lot of when we say deal flow, what we mean is how many deals come to you for investing. So the most easiest deal flow is always your friends and family. If your network is such that you have a lot of startup founders in your friends and family circle, then that's a great way to get deal flow. But that's not a ideal deal flow location, right? That's the most organic way to get deal flow. What you need to do is have syndicate firms like CrowdInvest or other platforms that are there in the world. Plus, also a lot of people choose to invest across, groups. The last one is based on your understanding of the market. This, what I mean is geographical or basis the category. And let us say you understand health very well. So health tech is a great thing. Suppose you understand SaaS very well because you work in a SaaS company, then SaaS could be a great opportunity and stuff like that. So these are the three criteria broadly in which you should be able to identify your areas of interest. And my suggestion is not more than three. The second most important thing which angels sometimes get wrong is you have to size your deals. Now, what happens is that it's very easy to think when you get, let us say, an angel is evaluating 5 deals this month. Uh, Typically, like once a week, you get a deal. So you're like, hey, fine. In this month, I want to do 2 deals and I have a deal flow of 5. Now, obviously, the 2 deals that you like, you may like one more or one less, but you may still choose to back both. The problem with having differential ticket sizes for both means you are trying to inherently put a bias that you think this company has a higher probability of winning. Now, the way VCs would do this is they will go in and de-risk, or they will go in and size their tickets according to their fund size. But because you are an angel, you have an income stream, or you have a particular amount of wealth, what you want to do is estimate the total amount of money you want to invest in 2 years and divide that number by 20. So the example I've used here is $50,000. And then if you divide that number by 20, it's $2,500. So your ticket size for every deal should be $2,500. Now, that does not mean that you have to do 20 deals, right? But the idea is once you get into the practice of making angel investments, your deal flow will increase, your level of confidence will increase, your level of understanding things like round details will increase. So therefore, if you do one deal a month when you begin your journey, you'll be doing 3 deals a month 2 years later. So that is why we say that you should have about 20 deals. The other reason for choosing the number of deals is that generally in VC world, we say that 2 to 5% of your deals go and get a super hit result or a super hit outcome. So if I only do 5 deals with the same $50,000 and it's $10,000 a bet, what if one of those 5 don't get it, right? I lose my entire 50,000. But on the other hand, if I make 20 bets and even one gives me a 50x, I've made 2x on my entire money. And my 19 other deals are still around to basically go and decide and go and sort of figure out if I can get a kicker on my returns. If you've 2x your money in 5 years, that's approximately a 15% IRR. So you're already beating the stock market in terms of the index. So the idea is that when you plan your angel investing journey, when you plan your angel investing round sizing, in investment sizes, always think of the number 20 and go with that success rate and hope to get at least 1 to 2 winners out of the 20. What also happens is that you really cannot do what we do when we come to capital markets. When we do capital markets, what we're trying to do is, suppose we have a diversified portfolio of 12, 13, 15 stocks. You will want all stocks to do well. Not that all will do well, but the best performing stock may also do 20-30% IRR at best. That is not the case with tech investing, right? When you do tech investing, your IRR will be 5x in 5 years, right? So it'll be close to 100%. So that is the difference that we get when we look at tech investing versus normal capital market investing. The last point over here is to create deal flow. Now, this is where most angels, I wouldn't say fail, but I would say have a weakness. The reason is because you cannot go and create enough deal flow for yourself, as it is assumed that an angel is not doing angel investing full time, right? What they're doing is on the side, and therefore they only have limited number of hours every week or every month to contribute or to donate to or to sort of dedicate towards investing, right? And therefore you will struggle to create meaningful deal flow. The other problem is, what do I say when I say meaningful deal flow? Suppose you like wealth tech a lot, right? And you're like, hey Pranav, I want to invest in wealth tech. And now you do a deal at $5 million valuation. 3 days later, you read in a newsletter or on Crunchbase, or you see an announcement in some media that a very similar business raised at $2.5 million or $3 million, or they raised at $10 million. Now, the problem is that because you did not have access to all those 3 deals, you ended up making a choice without having the option of that 2.5 or 10 million option, and you went for the 5 million option. But if you had the choice, you could have evaluated and compared apple to apple to see where you want to go and place your bets. So I think that is one very meaningful way. That's why we need to have a great deal flow, right? The other way to sort of create good deal flow is to read, discuss about those chosen industries, and do things like attend meetups in local cities, in whichever city you are in, especially if you're in a large city. And that's a great way to create deal flow for a particular industry you're interested in. As you go and meet more founders, or you go and attend more calls, like say CrowdInvest organizes a call for a particular startup and it's in your space, but you don't like it a lot, still go on the call because the founder will see your name. They'll probably follow you on LinkedIn and they'll probably bring you other deal flow or recommend your name to others because it's your chosen industry. So you should always do that. Another interesting way is to sort of write about it on social media, not disclose your deals, but write about your investing thesis or write about your industry preference thesis or where you see. So you will automatically attract a lot of people who are also writing or reading in that space. Lastly, I think the very, very basic step which everybody in this room should do for angel investing is to invest in packs through syndicates for shared diligence. Because when you invest in packs, it is essential that you get great deal flow because now you're sharing deal flow with others of your types. You can combine your capital to become more meaningful and meet the threshold of the founder. So let us say Pranav is raising money and he wants a minimum $10,000 size. But like we saw in this example, your ticket size is $2,500. So you may not meet Pranav's threshold. But if you're investing in packs and you have 10 other friends and you all agree that this is a good deal, maybe any four of you come together and you meet the 10,000, or maybe eight of you come together and you can do 20,000. And therefore, the founder now values you much more. Plus, a lot of times when you're looking at popular deals or deals that are oversubscribed, as we call it, that is means the founder has got interest for more than 1x of their round size. So if I say I'm raising $1 million this round, but the total interest I've got is more than 1 million, then I want to check and evaluate which are the found investors I should raise from. When you're investing in packs, your value addition becomes a lot more meaningful and a lot more stronger versus when you're doing it alone, right? So the idea of investing in packs is a great one. Of course, syndicates like CrowdInvest, Foundership will always be there. The other advantage is shared diligence. You're looking at paperwork, you're looking at a lot of entities. So all of that has overheads to it. When you're doing small bets, you cannot afford the overheads because it would eat into your returns even if you got that breakaway hit. So the best way to avoid that is to again invest in packs. You'll get the advantage of shared diligence. If anybody spots something you've not spotted, you'll get advantage of that. Plus, you'll entirely outsource or sort of share the burden of the transaction cost and time. And that is also a very big saving, which can lead to material changes in your returns when you look back at your angel investing journey. However, now I'm going to deep dive switching topics into Web3 and sort of taking what Karan also had asked in the chat, that how does tokenization work? What is different about it? What's peculiar about it? What's special about it, right? And because I work full time in Web3, we're looking at deals all the time. So the first statement, of course, right? I mentioned earlier as well, stock market listing is the holy grail for startups, right? So it is the end point for a startup in its journey. And we can sort of say it's the graduation for a startup into being a full-blown business, which is now going to go into linear growth. And on the other hand, Web3 has certain structural advantages. So, what are those? First, we need to understand why Web3 is different. So, tokens, which is what you typically get in a Web3 investment, are a tradable instrument, which is like a listed IPO. When you do a private investment in a non-token company, that equity that you hold may or may not be tradable, and you cannot sell your equity very easily in a day's time. But once your equity gets listed on the stock market, the liquidity is there, and therefore it's a trading instrument. Second is that tokens are open to global investors, both institutional and retail. What this means is that when I go to and list a company on NASDAQ, anybody who wants to hold that equity has to have an access to an American demat account or a broker or a fund that's American, that's investing in the US market. But if I am supposed from a market where I don't have that access, right? For the longest time, Indians could not buy American equity directly. This got solved about 4 years back. But we're seeing a lot more interest for Indians to invest in other markets. But when it comes to tokens, these are open to global because all the token markets or token exchanges are global in nature. And now the best exits are always when large institutions come in, right? So when you look at tokens that you hold as a retail investor or as an angel investor, you will be able to exit to institutions that are looking at that token as that business becomes bigger and bigger. Third, tokens are divisible into small units. Let us say you do that 2,500 example, right? And you have one stock of that company because it's now grown. You've got diluted. You started at 3, you got diluted by 2/3. So you're now after 4 more rounds. When it comes close to an exit, you have one equity stock left, or let's say you have two equity stock left because that company is obviously worth $100 million or hundreds of $1 million. Good problem to have, right? But what happens is if I want to partially exit, because if I got 100x or 50x or 25x in one investment, I may not want to exit fully. I still believe the founder, I still believe in the business, I still think it can go 10x from here. But if I have only one stock or two stock, I have to exit 50 or 100% of my investment. I cannot partially exit my investment. When it comes to tokens, even if you have just one token of a startup, I'm not saying that tokens are as heavily priced as equity, but the advantage is that tokens can be divisible even into uh, 6 or 7 or 8 decimal places. And therefore, you may exit only 5% of your token, recover 2x your money, and let 95% also ride, right? In the example that you went to, sort of 50 or 100x. So the advantage here is that tokens are divisible into fractions, and therefore you can do partial exits as the market moves or as those as those token prices go up. Second unique thing is that token holders are not only investors. When you look at traditional markets and you look at Web2 or tech companies, or you look at any listed company also, the equity investor is an investor. He may or may not, they may or may not be a customer of that company, and they may or may not be employees of that company. When it comes to Web3, everybody is holding the same token. The team is holding the same token. All the investors are holding the same token. The community that is tracking is holding the same token. And of course, the customers and users are also using the token, because typically tokens in Web3 will have a utility aspect. So all the customers will end up holding or transacting in that token at some point of their journey, even if it's something which is not available to the customer because they don't use that product, or it's not something that they want, but they could be tracking that project and they could be using that as a community because they are partnered with that project. So for me, I think token holders, token aspect of Web3 is super unique, right? It's something that is not necessarily intuitively understood by us because it's a new concept. It's probably 5 years old if you consider that 2008-9 when Bitcoin was invented to 2015-16 when Ethereum was invented, had no other tokens, right? Had no other crypto companies. But after 2016, we've seen thousands of crypto companies. The other advantage, which is not mentioned on the slide, is that token listings are not governed by stage of the business. So everything from an idea stage to a massive Series B level startup could be listing its token for the market. And that gives you amazing liquidity, right? It also gives you the ability to stop loss your investment. So when I say stop loss, it doesn't mean that look at it from a trading angle. What it means is that if you got into a token with your $2,500 check and you bought $2,500 worth of tokens, then when the tokens listed, even if it was not Series A or B or C or D, but it was just still in its seed round, and you now want to take away half your money because it's now worth less than that, you can still take away half your money or your entire money and keep that half to play another game or do another investment. So the advantage with tokens is that you're not bound to only have token listings for super mature companies, which is the case with tech startups. However, investing in Web3 has certain amount of language or nomenclatures that are used that are unique to it. So I want to take a few minutes to explain why I've not written the definitions here is because sometimes a definition narrows down the meaning of that term. But in the case of all these terms over here in Web3, they're fairly broad and therefore it presents itself in multiple ways. So when I say tokens, it means something which is a asset on a blockchain. A token is Web3 token when it is issued on a blockchain or minted on a blockchain. The advantage that you get with the Web3 tokens is that a blockchain is a central public ledger that maintains a record of all the tokens. So it's also trustless and permissionless. What that means is that anybody can access a blockchain that is a public blockchain to see how many tokens were issued, what kind of movements, what were the date it was minted, etc., etc. When you consider this and compare it with a private investment in a Web2, you really have to trust the founders or pay for an expensive diligence report or a financial diligence or a legal diligence to find it. And that will be a point of time. You cannot again update it without reaching out to those founders or getting a diligence report done. But when it comes to blockchain, you can look at the movement, you can look at how many tokens are issued, etc., etc., any point of time, and keep seeing if there is any change in the holding pattern, keep seeing what kind of distribution is there. You don't need to have large, don't need to wait for 3 months for a quarterly update. You can see it on the chain. The second part about tokens is the word you'll come across very often is vesting. What does vesting mean? When we talk about equity investing, especially in tech startups, vesting is what we do for things like ESOPs, but investors don't get vested stock. Investors will typically get stock issued as and when the startup issues the stock, and that will be done as per the formula or the valuation that the investor has invested. But when we look at tokens, because there is no dilution in tokens, right? As you issue on smart chain tokens in one go. So suppose a project like Bitcoin will only have 21 million Bitcoin. So tomorrow you know that one Bitcoin is going to be one Bitcoin. But when you are doing standard equity investing, if the company does a 10% more dilution in the next round, and you do not do a equivalent number of investing as your percentage, you will get diluted down. So you will hold 10% less equity in the company. So if you had a 1% and you didn't put more money and the company did a 10% dilution round, your equity would now be worth, your number of shares would now be worth 0.9%. And that means that though the value of stock may go up if it's a up round, or it may go down if it's a down round, you've now got a smaller percentage in the company. Versus when it comes to tokens, if you have one token, it is one token. It is not going to be changed because the one token will still be 1 out of 1 million or 1 out of 10 million or whatever is the number of tokens. So therefore, they do a vesting, and a vesting is basically a vesting schedule. So every project, when they take investors pre-listing, will give you a vesting schedule, which will apply from the day the token is listed. Listing is exactly what we see in Web3. It's the listing. It's also referred to as token gating event, where tokens are sort of sent out the gate into the public markets. And what you will see which is 1.4 is ICO, IDO, IEO, STO kind of abbreviations. ICO is initial coin offering, initial DEX offering, initial exchange offering, security token offering, right? So these are the full forms of these particular words. But what they mean is that when there is a listing, the project may do a combination of one or more of these. Why I've put security tokens there is because I'm assuming that at some point you've come across some nomenclature or somebody asking and telling you that tokens are actually securities. But that has been now sort of a subject of several legal battles. So I'm not an expert to tell you what the legal outcome will be. But there are provisions for a security token offering in the market where instead of issuing equity, you can issue tokens which are securities. However, the bulk of tokens that you see in a crypto market or a crypto exchange are not security tokens. They are what we call as utility or engagement or similar tokens. So that's what we mean by ICO, which is coin offering. Then D is for decentralized or DEX offerings. IEO is for exchange offerings, and STO is a security token offering. Lastly, we're looking at exits because you have a vesting schedule and because the listing can be in a multitude of exchanges, right? So now you're seeing it's not the same like Web 2. So typically when a company lists on Web 2, they'll go and list on one exchange or they'll go on list on one market. So if it's India, they may do National Stock Exchange, Bombay Stock Exchange. If it's America, they may do NASDAQ or NYSE or something else. But when it comes to crypto, there are multitudes of exchanges. I think there are over 100, 200 exchanges all over the world. And all of these exchanges are open to listing tokens from everywhere in the world. So therefore, the listing is not something that's restricted to one market. And it goes back to my point on why tokens are peculiar because they allow access to global investor base. For the token price will be same across all exchanges, unless there's a short-term arbitration opportunity for some reason. But otherwise, the token is same across all the exchanges and it's a global market. So that is a very peculiar thing. Now, when you think about that and you think about exit, what you have to see is the market making and the liquidity in tokens is much higher. So even for small cap tokens, which may be worth a few $1 million, you're looking at liquidity being decent in the case of exits for retail investors. The other point which I already mentioned was how tokens can be diluted, can be sold in parts or fractional basis, and therefore the exits can also be partial. So you don't need to really exit fully. The last point about exit is when a token is listed, even if it's a seed stage company or a private stage company, a pre-seed stage company, or a series A, B, C, D company or startup, you don't need to ask the permission of the founder to exit from the company. In the case of Web 2, you will typically have a drag along, tag along, or a FIFO or a right of first refusal or something, ROFR, built into your equity agreement, which stops you from going to the market and selling it in secondary. In the case of tokens, you cannot do that. They cannot stop you. So you will be able to exit your tokens much, much, much faster and much easier than equities. So Web3 versus Web2, right? What's the key difference between uh, these two types of investing?
Sorry, Pranav, one question quickly on the last slide.
Right.
What are the
Right.
different ways of exits which the investors can get, like secondary exits, which you must be talking about? So, what are the ways, like by peer-to-peer exchange platforms or selling it off? How the price is being negotiated between the buyer and seller? A bit on that would be helpful.
Yeah, sure. So the advantage with tokens is that once they are listed, you can literally go to any of the exchanges you have access to, and the decentralized exchanges are permissionless. So if you have your tokens in your Web3 wallet, you are able to go to a DEX and sell it at that DEX without asking anybody, without anything. It could be a partial or a complete exit. That is not always possible when it comes to equity because there's so much to do, including banks, demat, there is a demat holder or a secure exchange. Plus, even the timing part, right? Crypto markets are 24/7. That may not be the case with NASDAQ. So if you want to list today's Thursday evening in Dubai, and we're already past the market hours. If I want to sell my Indian equity right now, I can't. But if I want to sell my Bitcoin right now, I can. It's a 24/7 market. Also, there are options, exotic options like staking or lending against or borrowing against your tokens. When we do that in equity, it's mainly for very large listed companies. But in the case of crypto, there is a much deeper market that allows very small market cap tokens also to be securitized and borrowed against. So these are all ways in which we can get exit, right? Depending on what your intent or what your purpose is. If you want short-term liquidity without selling, you can borrow against it. If you want partial liquidity, you can sell partial. If you want complete exit and you're like, I'm done with this project, I'm going to exit now and evaluate later, you can completely exit in any of the global markets. So coming back to Web3 versus Web2, exit timelines. I mentioned that when it comes to Web3, you can list tokens as early as pre-seed, seed, all the way down to mature ABCD type rounds. But when it comes to Web2, the exit timelines will go into several years. Anybody, even the folks at CrowdInvest will tell you that when you enter an angel investing transaction, you should always think of a 3, 5, 7 year timeline before getting an exit. That may not be the case. In the case of Web3, you can get an exit even before the company goes for a Series A or reaches that stage. Therefore, the exit timelines are very different. Second, equity plus tokens. A lot of times, what you will see when you do early stage Web3 investing is startups will offer you equity plus a token, which could be structured as a equity safe or a share purchase agreement or something, along with a token allocation. The advantage of that is that you are able to, now the startup says, hey, if I build an IP, what is the advantage of an angel investor or any investor who holds equity? I'm building an IP in my startup. If it doesn't work out, my IP still belongs to the company or the startup. And therefore, my investors can still get a preferential exit if that startup can sell the IP or monetize the IP, even though the business may have failed. Therefore, your exit becomes sort of mitigated by that equity holding. But if they are able to build a business out of it, or if they're able to take it to a token listing, you will receive tokens from me as a startup. And therefore, you will be able to take that token and go to the market and get your exit while still keeping your equity. So you actually have two plays. You can get a initial exit or a earlier exit from your tokens while still maintaining your equity in that startup, which could lead to much more IP, much more gain over the long term 5, 7, 10 year horizon. So I'm reading Avinash's question. Avinash, it was exactly what I was trying to say in this point, which says, can any startup handle both traditional mechanism, which I'm assuming you mean equity, and token mechanism while raising fund? Yes, absolutely. A lot of early stage startups, including ones at Foundership, we recommend them to get into safe plus token warrants. So it tells you that, hey, you're investing in this safe at 5 million, and I will give you tokens also for that much percentage or for a different percentage. So the advantage here also for the startup founder is you can do things like safe at 5 million, but tokens at 10 million. So see,
So,
sorry, yeah.
yeah, sorry. Yeah, I have just follow-up question here. So,
Yeah.
how exactly the the total supply of the equity and tokens will work here, like into both sectors? Because when we launch the token, right, we have to have like define all the sort of maximum tokens which can be like mint or released to decide the market cap. So when we having both equity and tokens parallelly at the time, right? So how exactly that gonna fit into the market? Because at the end it's both part of the same company, right? So can you just like give some idea on that part?
Yeah, so tokens are not securities, right? Where you will hear all of us who work in the Web3 space come from is we are very clear that tokens are not securities. So in the case of equity, it's a security, it's governed by whatever are the laws of that region, whatever are the laws of the jurisdiction, and whatever are the mechanisms of the jurisdiction. When it comes to tokens, you will typically get a token warrant when you do a dual instrument, which is a right to tokens, just like a safe, which is a right to future equity. Similarly, tokens will be issued when, like you rightly said, tokenomics will be established and the project will decide how many tokens, what are my percentage tokens I'm giving to investors, what are the vesting schedules for that token. Only then will the tokens be issued to the investor. But the investor will get their token warrant the moment they sign the paperwork for their investment at the time of making the investment. So think of it as equivalent to the safe. The other language you'll see used in crypto Web3 is SAFT, SAFT. SAFT is the same as safe. Instead of uh, this thing for future equity, it means future tokens. So some companies that don't do equity may do a SAFT only and therefore raise money on a SAFT. So they don't need to issue the tokens upfront when they're raising the money.
Okay, so just one more question here. So how
Sure.
the pricing will impact, because whenever we, I mean, suppose if we go initially with the equity model, right, and we like raise some fund, we allocated some equities to the investors. Then when we are deciding to go public while launching the token, right, then actually we'll have to decide the price on multiple factors. So whatever the price, I mean, that I just wanted to understand that how much the variation could be from a normal equity pricing what we have allocated to the investors. There could be huge difference while we are building. So do we need to like keep in mind those factors, that how much equities we have already like been allocated to the investors, based on that the price of the token should be like decided, or because that can vary a lot, right, in terms of if they wanted to do an exit, because the price should be the same even if the traditional web2 investors wanted to take an exit. So for them the price would be the same which we have listed the token, right?
No, actually, any investing, just for 1 minute, forget Web2, Web3, token, equity, whatever, right? Whenever you take an investment, you either agree on a fixed valuation or a formula for determining the valuation. Nobody goes in and says, hey, here is my money, let me know whatever you want to give me later, right? At that point, you'll say either there is a fixed valuation, let us say $10 million valuation for investing in Pranav's company. Equity or token doesn't matter. There is a valuation number or there is a formula which says, I will give you 20% discount to next round with a floor of 8 million and a cap of 12 million. And whatever is the number between 8 and 12. Or there may not be a floor and cap. You can just say, I am going to give you a 20% discount over whatever the next round is, and it's uncapped. So if I raise my next round at 25 million, 20% discount is 5 million. So you'll get your valuation at 20 million value. You'll get your equity issued at 20 million valuation. But at any point of time, there has to be a valuation number. Whenever that
Hmm.
valuation number is set, irrespective of equity or token, if this is a dual instrument like a equity and token, equity plus token deal, then you will set the valuations for both. You
Hmm.
cannot have, hey, I'm giving you equity at 10 million, but token, I'll think about it later. Let me know. So it doesn't work like that, right? You're not going to give money to that founder. You should not give money to that founder. Please stop what you're doing and take your money and go. But if the founder says, hey, I will give you equity at 10 million, but my token is going to be listed at 50 million in 6 months from today. So I will give you token at 25 million. So
Hmm.
let us say 2.5 to 1. And
Hmm.
that's a
Hmm.
fair number, right? Then it's your decision to choose to invest or not, saying whether you like the valuation. But the founder will come and give you
Hmm.
valuation and peg the investment for both instruments. The founder cannot have a instrument like token without a valuation and equity only being valued. Ultimately, both will be valued.
Right, right, got it. Yeah, thanks for
Good.
makes sense.
The
Pranav, I
third,
have a question as well as a newbie,
sure,
complete newbie.
please.
So it's like obviously I'm not talking about ICOs, I'm talking about, private fundraise, which happens via equity, say for example, like on a crowdfunding platform. Over there is not going to be any fluctuation unless and until the company just, happens to have a negative incident. For example, right, when they launch their crowdfunding campaign. But when you launch tokens or when you're playing in the Web3 market, then there are two prices, right? Like one is the price of the token that it was launched at, and then if you go to CoinGecko and stuff, there could be a market price. There could be a difference between the two, right? So even as a founder, if you're telling me that I can give it to you for £1, for example, the market price could be like 0.40p. Like, am I able to express myself?
No, so yeah, yeah, I get what you're saying. I think I get what you're saying. So what you're saying is the listed price and the offer price, right?
Yeah.
So if a token is unlisted, only then does the founder or the startup decide its valuation, or the lead investor decides the valuation, and you get that valuation with you. But if a token is already listed, there is typically a formula that's set up that says, hey, this is my token price. This is the last 90 days. I'm offering it at a 10% discount to the last 90 days. Because obviously, Pranav can go buy it at today's price, right? Because it's a listed entity. So it's a listed token. So in the case of listed tokens, you will typically buy in the private markets at a discount to current price. Why would you buy at a premium to current price? You just go and buy it from the market, right? So let us say if I am a founder of a company, let's say Foundership had a token tomorrow, right? Till the day it's listed, I can give you a valuation. We can agree on that number, and that gives you X number of tokens at depending on your investment size. But once the foundership token is listed, and I still want to raise money, right? I can and I should and I will. Therefore, I will go and say, hey, I'm giving you a future token, or I'm giving you a vested token, which will unlock over the next 12 months. My last 90-day, 180-day, 30-day price was $1 or £1, like you said. But I'm offering you a 20% discount and giving you 80 cents. And here is my business plan, which means this £1 is going to go to £3. So not only will you make that 20-cent spread, but you'll also 20-pence spread, but you'll also have that opportunity as these tokens unlock over the next 1 year, you will be able to realize £3 from it.
Got it.
And then, of course, the investor takes their call, right? So that's how the listed token works, which is not dissimilar to a future public offering or an FPO, or a further public offering or a FPO that we do when we do a capital market transaction, right? So let's say it's a listed company, they want to raise 1,000 crores, or they want to raise they want to raise $100 million, then they will go and do an FPO, or they may do a rights issue, or they may do several other things, or a convertible instrument or a warrant or something, and raise that money, right? And that also typically has a formula, it has a hurdle rate, it'll have a strike price, so it'll have all sorts of combinations, right? And all of that can also be built into tokens that are already listed. So now when it comes to regulatory, when we look at regulatory, the Web3 and Web2 is very different. People will hate me for saying this, but the Web3 is still in a phase where the rule book is being written, right? So I don't want to say it's Wild West, but it's pretty close. So it's not very well governed by laws. So you don't have things like you'll get a quarterly report as a shareholder. There'll be minority shareholder protection. There'll be insider trading protection, which is all that is part of a mature market like stock market. But Pranav, why are you still doing Web3, right? That should be the obvious question. Why are you advocating Web3, or why are you even participating in a market that's not the case? Because in the last 100 years that we've seen the capital markets evolve, those regulations have come as a matter of practice. Regulations will always be a lagging indicator to the market trends and market practices. Every stock market in the world has gone through its own cycle and has learned from others in the world on how to regulate the stock markets. The same thing is going to happen to the token markets, and that is why I think it's a great time to educate yourself about token markets and token practices, even if you don't choose to invest, right? You don't need to invest today. But as regulation keeps coming, things like VARA, which is the Virtual Asset Regulatory Authority in Dubai, or the MICA in EU, and there are other geographies. UK is looking at look at crypto regulation. India is looking at a crypto regulation. Singapore, Hong Kong, US, all of these markets are looking at bringing crypto regulation. So I feel that just like stock markets, crypto markets will mature and be regulated over the next 3 years. But today they don't have that regulation. So if you get into a token market, you have to understand that it's more riskier than a capital market. But obviously, following the nature's law, higher risk is higher reward, right? So therefore, you can also get a 50%, a 50x on a token in a month or in 2 months, right? Or if you've ever heard of meme coins like Dogecoin or Dogecoin or Shiba Inu or Pepe coin, then you'll see that they would have pumped 50, 100x in 2 days. So the idea is that these tokens are not going to be regulated soon, today, but they are going to be regulated over the next few years. And therefore, you have to come in with that kind of allocation to token markets, unless you're really in the industry and know how to manage the risk. Next is transparency. I already mentioned some part of it, like the reporting, compliance, insider trading. So Web2 has a lot more perceived transparency. When I say transparency, I'm talking about a reporting transparency. But the advantage with Web3 is that it has a transparent blockchain. So you can actually understand what's going on in the token by opening up the blockchain explorer and seeing what's the movement of the token. That is a very unique transparency that is not available on a standard investment or a standard Web2 token, sorry, equity market or a equity stock. So I think the transparency is very unique to Web3 because it's a technological transparency. You are able to go to, so suppose like I use Avinash's question, right? Where they were using traditional mechanism versus token mechanism. So I come and tell you, I'm going to issue 1,000 equity stocks for $100 each. So therefore, I'm raising $100,000. But you have no way to know whether I issued 1,000 or not unless and until I actually go through with the DMAT issuance and I issue that equity. But when it comes to token, the moment I issue my token and I say I'm going to do 1 million tokens at 10 cents and I'm going to raise $100,000, you will be able to see on chain that I only released 1 million tokens. And those million tokens then are going to be there in that fashion, whatever is their release as per their smart contract. So that is transparent on the blockchain. You don't need to trust somebody to tell you that these are the million tokens for this particular project.
Pranav, a bit on taxation would be helpful if you can cover if somebody
Yeah,
in the
sorry.
community would
I
like
think I
to.
skipped, I think I skipped taxation, my bad. So
Yeah.
taxation, why it's important to understand is equities have a very mature taxation treatment, right? So especially the larger stock markets in the world, where everything from US, UK, Hong Kong, India, uh, Europe, all of them have a very mature, Canada, Australia, have a very mature taxation, whether it's long-term gains, short-term gains, derivatives, all of that is very well defined. And there is enough advisory, etc. for those. When it comes to token investing and especially Web3 tokens, you're looking at taxation still evolving. So every country has different taxation, and some of them have, I would say, disincentivized token investing because through their trading. So at some point they realize that it's impossible to stop the internet. So you can't really stop people from buying tokens. But what I can definitely do as an administration or as a government is tax it very heavily or tax it unfavorably so that I dissuade the common person from going and participating in token investments. So India is a great example. There is a 1% TDS or tax deducted at source for any crypto trades you do. B, your profits in crypto trades are taxed at flat 30%, irrespective of your income slab, without a loss offset. So what it means is if Pranav makes 5 trades, one of them is profitable and 4 of them were negative, I will have to pay 30% on my one profitable trade, but I get no offset for my 4 loss-making trades. So therefore, it disincentivizes the participant from going and doing token trading or token investments. Versus in the case of equity, you'll typically see lower taxes for long-term gains if you hold it for a year or 2 years, depending on the market. Every market has its own rules. Short term may be gained, may be taxed at your tax level, at your tax slab or your income levels. So therefore, it may be variable rates and things like that, right? But that's not the case with this thing. So before you participate in any token investment, please take some time to understand the taxation of your jurisdiction, whichever is your respective tax jurisdiction. And if there is a token tax or a separate token taxation, it is very important to be clear what that tax rate is or what that tax system is before you participate in any token investing. Just so that you're not blindsided, right? Like the Indian law. What I wanted to do was sort of share a particular investment opportunity, which I have done a very small piece in the last couple of weeks. So it's a very new deal. The idea here is that this particular deal is a website, a product called games.gg, and this is a launched game. It's got certain. So this is the blurb or what I would call as a summary. So typically, as an investor, you will expect a summary like this the first time you receive a deal flow. Because if somebody is sending you just a pitch deck, that's not a great way to get a deal flow, right? Because there will be a lot more that's not mentioned in the pitch deck and will mean that you need to go and find out on your own. But typically, a good product or a good project will send you a blurb, or somebody who's bringing you an investment opportunity will bring you a blurb. And this is a Web3 blurb from a few weeks back. Uh, so these are the game discovery. This is what it does. They basically help the user with game discovery. They give game reviews and guides. They obviously help build a gaming community, and they'll do games rewards as well. The future plans are to have a gaming passport, sort of think of it as a central ID that goes across multiple games, like your Apple ID has a Play Center or a Game Center ID, or Sony has a Play Center ID. They want to have gaming launchpad so that they can help other games launch in the future. And then you have gaming tournaments, which we all know of. And these are all, a lot of these gaming are basically Web3 games. You would have heard of concepts like Play to Earn, X to Earn, whatever. So these are typically the target market for this kind of a platform. They want to bring Web3 games to their user community. And you can see their vision over here. Vision is to bring one-stop shop for Web3 gaming to help onboard millions of gamers and allowing them to engage with blockchain-powered games in unprecedented ways. And obviously, you want to, they're saying, and become the ultimate bookmark on every gamer's device. So they are looking at being a one-stop discovery, review, user engagement tournament site for games. Key statistics, right? 150,000 registered platform users, average session time of 5.5 minutes. 50 quests means there's people, games are going to this platform and saying, you bring users to me and I will give you money. So this is B2B revenue generation for them, which they've got 30,000 unique participants and 450,000 activities completed. They've done 300 games on their platform, reviewed 140 games, and published 88 guides. They've got several interviews, several newsletter subscribers, and they're basically building a play now feature where you can directly play on the platform. So think of it as a stream or whatever we do in Web2, where you can play from the Steam platform itself. But this is for Web3 games. And they're looking at Games Brand, which is the Web3 gaming event with 450K votes and partnerships with Google, Xbox, etc. So they had that in December last year. Now we're looking at Discord. Discord is one of the community platforms which you can say is very similar to Telegram communities, LinkedIn communities, but it's a little more Web3 specific. A lot of gaming people use Discord. So they have 97,000 members on their Discord, 110K followers on their X, which is Twitter, and 18,000 Twitch followers plus 8,000 YouTube subscribers. This is the name of the team, some experience of their previous work X, and other partnerships. So a lot of these games you may not know, but at least 4 or 5 of these names are fairly popular and large Web3 games, either existing or about to be launched soon. So these are some great partnerships they've got. And oops, yeah. This is the ecosystem they've built. Magic Eden is a NFT open marketplace. Polygon is a chain, gaming, Avalanche is a chain, Solana is a chain, Immutable is a chain, Binance is a chain, Ronin is a chain. So what they've done is about half a dozen chains they're live with or partnered with. That means that they'll be able to tap users and service games that are operating on all these ecosystems. And they've given some links. Why invest is what's there. It's likely to be listed on Binance in, sorry, it was the team is from Polka Startup, which was last listed in Binance in May. So this has a high chance of being listed in the current, on Binance. And we're looking at the last round. So this is the fundraising details on the right side of this. I'm going to, sorry, just going to use this. Yeah. So you can see here it says round raising 1 million at 30 million, and it's 4x oversubscribed. So this is the round size, right? They're raising $1 million. The token valuation is 30 million. So what we say is that the token is going to be valued at 30 million. That is all the tokens of this project. Unfortunately, it's not written over here how many tokens, but I'm sure the pitch deck had that. I should have put it here, but I don't have it here. But let's assume whatever X number of tokens were there will be totally valued at 30 million. There is a 5% vesting, 5% unlock at TGE. That means that 5% of your investment or investment of this 1 million will be also $50,000 worth of tokens will be released at token listing. Then for 3 months, there is a cliff, that is no tokens will be released. And then 9 months, those remaining 95% tokens will be vested. So this is an example of what they mean when they say vesting of tokens, right? So you're looking at 5% TGE and a 3-month cliff and a 9-month vesting after that. Then the token is going to be used for tournaments, gaming passport, loot boxes, launchpad. So think of loot boxes as like trading card packs. So you can trade your tokens and buy packs and unlock them, and there could be NFTs, prizes, boosters, etc. for the games on the platform. They're looking at doing TGE. TGE means token gating event in March 2024. Of course, like I said, right? All these are indicative. There is no legal binding that they will do a release in March, but that is their plan as of today. They are going to use a launchpad called Polka Starter, which is where all these guys are. They will list on tier 1 exchange and OKX, that's pending. Their previous round was $2 million raised at 20 million in Jan 2022, which is about 2 years back. And all of these are the investors in this project. So that is sort of, this is just so that I'm able to share with you all what a typical Web3 deal looks like. And these are the kind of deals that I spend most of my time evaluating and investing in. And it may look if you think about it in essence, it's exactly the same as any other tech investment, right? But the advantage is that because you know that this token is about to be listed soon, even if not March, at least in the next few months after that, your exits could be as soon as 6 months from today. So I'm considering, when I say 6 months, I'm in January now. It lists in March, which is 2 months away. I get 5% of tokens in March itself. And then 3 months later, which is 5 months from today, I get my cliff is over and my 9 months of vesting starts. So that is the way in which we typically evaluate uh, tokens. And just to sort of share and ask a question on whether you think I've been able to intrigue you enough to consider investing in Web3. Tanya has put up 3 options. Happy to see what your answers are. So we'll do this quick poll whenever you
You all
have the
should
result.
receive a poll on your screens, and you can just select one option, please. Or feel free to just say it out loud, whatever works.
So yeah, meanwhile, thanks a lot, Pranav, for your session. The poll is running. It was very useful and very informative session you took. I am sure like a lot of our community members would be feeling well confident after hearing from what you have told about Web3 investments. So any questions finally for Pranav, so that if you have any questions for him, he can take those questions right away. Otherwise, feel free to get in touch with all of us after the session. Yeah, so there is a question, Pranav, for you.
Yeah, please. I'm just going to open the chat if that's okay.
Yeah.
Uh, sure, Rahil, feel free to do that. The CrowdInvest team is also there. We can put our LinkedIn in the chat. The initial thing had my LinkedIn as Linktree as well, so you can use that as well.
Also,
Oh,
we'll be sending a follow-up email which will have both foundership as well as CI call to actions, and you can connect with us. And also, this is just the first part of our series. Obviously, that's why we started off with the basics. So the team will be in touch with the following sessions, and hopefully we can retain the audience and you guys enjoyed yourself.
Yeah, what we'll do is we'll just send at least all the registered participants one invite whenever we set up our next session. And
Yeah.
if you think there's any particular things which you intrigued you or which you want to know more about, would be more than happy to sort of get that in either an email or text or whatever.
Now, Pranav, if
We'll
you can
keep that
kindly
going.
just scroll, your email is already on there, the next slide. So maybe people can just grab a screenshot or something and know
Yeah,
how
I'm
to
just
get
very
to
bad with email, so please don't mind if I don't reply. But yeah, I'm just giving you a heads up. Otherwise, you'll think that Pranav is being this thing, but it's not that. I just don't. After my corporate job, I hate checking email for
We
50
are with you.
just that.
Also, we'll be sharing the recording with the event attendees. So, if you feel like you just need to like go back to a certain concept, or maybe like when you rehear it, you have questions, I'm sure, you can address the questions to either one of us, the CrowdInvest or Foundership team, and we'll try to get back to you ASAP with an answer.
Perfect. Perfect.
Perfect. So, if no further questions, so should we take a leave because we are already running 17 minutes over, and I'm sure everybody has a
For
busy
that, I can't
afternoon.
stop talking once I start. So
Yeah.
You did a
I'll
wonderful job, Pranav.
No worries, guys. Thanks a lot for the opportunity. Always a pleasure. I think one of my main sort of, I call it my personal KRA is to evangelize this space. I think we're going to see a ton of real world assets get tokenized over the next decade. And I just can't wait to sort of, onboard as many people into Web3 over the next several years.
Perfect. Thank you so much, Pranav.